Markets want from Budget 2016?
Hello and welcome to this very special show, What Market Wants. In the run-up to the Union Budget, we are here to decode what the market should be looking out for as pros and cons in the Union Budget. As we all know, this time the government has the impossible trinity of meeting the fiscal deficit target, spurring growth, as well as making a lot of expenses as far as the 7th Pay Commission and ORAP are concerned. But will the government manage to walk that tightrope well? We have 4 experts here who are joining us. Anuj is also here with me. Anuj, historically, budgets have not moved the market much. I mean, it's been a 1, 2, maximum a 3-day affair. Do you think this time things will be different?
Yeah, anecdotally, there's not been too much of a move post-budget, as you pointed out. Most post-budget moves have been on the negative side. This time, the solace could be that we haven't had a pre-budget rally to begin with, or at least much of a pre-budget rally. So in that sense, the room for disappointment is low. That doesn't mean that the market cannot fall post-budget. In any case, the market has been moving on global cues more than the budget, but budget is important. So let's ask our experts. In fact, we have Nilesh Shah from Envision Capital, we have Neelkant Mishra from Credit Suisse, Gautam Chowcharia from UBS, and of course we have Dinesh Kanabar from Dhruva Advisors. Taxation would be an important cue. Neelkant, let me start with you. How important is the budget for the market, and what's that one thing that the market would be watching out for?
No, I think the budget I've held for several years, I would agree with Sonia, it doesn't really matter much. If you see, UP has presented a budget which is 3,50,000 crores, which is almost 25% of what the central government is going to present. We haven't seen even the detailed documents yet, and no one is even discussing them. We have seen Jharkhand present a 15-16% increase in their expenditure for FY17. We haven't seen any discussion of that. Economically, those are things that matter a lot more. As we've been saying repeatedly, more than half of BSE 100 revenues come from the world, not from India. And so it doesn't matter, but yes, from the perspective that all of us are discussing it, I think there is a sentimental value to it. From a fundamental perspective, I think what matters are just 3 things. The first is whether the government sticks to the 3.5% target or not. Yeah. The second, because that will affect the bond markets, what the global investors think, it can affect the currency, there can be a cascading effect. The second is how the government goes about doing that. If they do that by raising taxes, I think it will be counterproductive. If they do that by giving an aggressive and achievable target on disinvestment, I think that will be good. And thirdly, the pay commission. I mean, I don't think this is a burden. I think it can be a much needed stimulus because it can stimulate very wide reaches of the Indian economy. And I think it can be very, very growth stimulative. Stop here.
Okay, I want to take that point forward because Gautam Chowcharia of UBS has a completely different view. He doesn't believe that the pay commission can stimulate the economy. Certain parts of it may be, but not the entire economy. Gautam, welcome to the show. Firstly, if the fiscal deficit target is relaxed, will it be seen as denting credibility? And secondly, on that pay commission point, what's your view?
At the margin, small relaxation here and there won't matter. Because in the macro context, 0.1, 0.2% of GDP, not a big deal. But yeah, credibility-wise, government has laid out a roadmap. It kind of diluted it last year. So purely from a credibility perspective, a 3.5% number is relevant, specifically for bond markets and currency. Specifically the pay commission, the bigger issue is with the states, not with the central government. Central government is 0.4, 0.5% of GDP. State government is 1.2% of GDP. And they're already running near their fiscal limits as per FRBM. So where's the money they fund that? Central government has money from oil bounty. State governments can fund it by cutting capex, cutting healthcare, education, or increasing taxes, or increasing fiscal limits. So the point we would like to make is quality and quantity of fiscal consolidation is both important. So while 3.5% number will satisfy a large part of the market as far as stability is concerned, but in most scenarios, quality of fiscal spending will get hurt. Because you are moving away from capex to spending more on revenue side, specifically pay commission, and more so for the states.
Okay, Nilesh, what's your call? Are we giving too much importance to this fiscal deficit number of 3.5%? I mean, does it matter whether it's 3.5 or 3.7, 3.8? Would the market care much? And secondly, what would be the most important number that you'll be watching out for from budget?
I probably think this time around the fiscal deficit number is going to be very, very important. Maybe 3.5, 3.7 may not make too much of a difference. I'd probably say that 3.8, 3.9 would be kind of the Lakshman Rekha. that's a line which should not be crossed. Because what really is making India very different this time around is basically the macros. The fact that India's macros haven't been so good in the last 3 or 4 years. That's one thing which really makes India stand out versus some of the other emerging market peers. And therefore, this budget has to be about sustained credibility, that we stick to the path of fiscal consolidation. That is something where the government should not kind of, let go on that path. So I think it's going to be very, very important. Perhaps that's going to be the most important factor.
Okay, so that's about fiscal consolidation, which is a very important factor. But Mr. Kanabar, I'm sure you're hearing a lot of rumors about the possibility of that long-term capital gains tax, that extension. Is that just fear-mongering, or is there some possible truth to it?
So I say this ever so often that if you just step back and take a stock of all the rumors that go around on what's going to happen on the taxation front and actually compare with both what happens on the day of the budget, the two are really totally uncomparable. They're purely coincidental if there are certain things going right there. I think this time, if I look at, I have heard number of rumors go about where people are talking about imposition of estate duty, people are talking about taxing of dividends. To say that beyond the tax that is paid by the company, if a recipient gets more than a certain amount, there could be an additional tax and a number of other things which are being spoken about. Of course, there has been this rumor going around about increasing 1 year to 3 years for qualifying for long term. And the way I would look at it is that from a concept perspective, I would think that's the right thing. 1 year does not make anything long term. 3 years is a reasonable period. The question is this the right time to do it? And is this the point of time when the government is falling behind on the disinvestment targets? People are not really making gains in the market. So what really is that gain that one is looking, or what is the tax one is looking at if shares are held for a period of 2 years and being taxed on a short-term basis, incremental 2 years? And I don't think those numbers are very high compared to what the government may need to give up on STT as a result of that. So I really, that's all rumor mongering, and I really don't have any view as to whether it'll happen or not happen. But this may not be the right time to make it happen is what I certainly can tell you.
Okay, let's get the market's perspective on that. Nilesh, in stock markets, you have to be prepared for all eventualities. This might be just, fear-mongering, but this is a possibility that's being discussed. What if the long-term capital gains tenure is extended from 1 year to 3 years? Let's begin with that. Do you think markets will react negatively to that? And if yes, based on that, how much could be the downside?
I think increasing the time frame from 1 year to 3 years is not something which is going to terribly, disturb the entire markets. You could have a knee-jerk reaction, maybe just a temporary 4 to 5% correction. But that's about it. I don't think that's something which is going to be kind of a deal breaker on the negative side. I think the worry is that if you actually have long-term capital gains tax getting introduced, I think that is something which could really impact the markets, and maybe the impact out there could be even more than just a 4 to 5% temporary cut. So I think that's really the thing to watch out. If it goes from 1 year to 3 years, you'd probably see one small cut in the market, but that's about it. I think then the market will go back to all the other proposals which are there in the budget and saying, okay, fine, everything else is pretty good, so let's move on.
Okay, Nilkant, what about you on the taxation front? Not just long-term capital gains, but other things like removal of exemptions, service tax could be hiked in order to make that smooth transition to GST. What would disappoint the market this time around?
What could disappoint the market? I think all the negatives that have been discussed in the market, I think there is one element which perhaps can be a further negative surprise, could be that this universal healthcare insurance scheme that is being talked about. And if you see, for example, what happened in Turkey I think this is the inspiration for that scheme, there was an additional surcharge applied on all taxes on top of that, so to fund that scheme. Now, given where India is in terms of out-of-pocket expenditure is 85% of all healthcare expenditure, which is completely undesirable. The government needs to play a bigger role. So the government's role in the healthcare has to improve. But if such taxes start getting imposed, I think the perception in the market could be negative. But other than that, I think most of it has been discussed. Okay. I think excise on petrol and diesel itself, if current rates are continued, we'll get another 73,000 crores next year, an additional 73,000 crores. That's quite a bit. The service tax going up to 16%, I think, is now well and well expected. So I don't think anyone will be surprised by that. Other than that, I have not heard of, or I don't expect anything big negative coming up.
Okay. Gautam, would you expect this excise duty hikes to continue? I mean, we have another round of crude price fall, do you think that would be the other source of revenue? And in that sense, we should be starting to budget more from excise revenues for next financial year.
Looks like that's what the government has been doing. But even if you analyze the rate hikes this year, as Neelkant was saying, there's a lot of room for higher excise revenues next year.
Okay. I wanted to shift focus to another topic.
Sorry, could I just come in
Yeah,
and just
sure,
make a
of
comment
course.
on all the 3 points that were made? So I think Nilesh made a point about introduction of long-term capital gains if there isn't any. So first, on the immediate impact, given the fact that much of the investment which happens, particularly from overseas, the FI investment, still comes through Mauritius, a very significant portion of it. Whether it is 1 year or 3 years may not really impact those people at all. That's one thing we need to be factoring. And second is, if at all there was to be a tax imposed on long-term capital gains, I would presume that in lines with what was originally recommended in Direct Taxes Code Bill, which got scrapped, the date of cost would move to 31st March that year. So your cost base goes up. So assuming that you're going to pay tax, you're going to pay only on the gains thereafter and not on the gains which you already made. I think that would be very, very logical to do.
Okay, let's do one thing actually. Let's take a break on that note.